So, Akash is a new member joining the forum today. So, what I'll do is I'll very quickly revise the topic that we had discussed yesterday, and from there we will take up our discussions going forward, right? So, basically, in the last class, we started discussing about the different kind of losses that banks make and the role that capital and provisions play in maintaining or in preventing those losses. So we saw that banks face, so broadly there are three kinds of losses based on their frequency of occurrence that the bank faces. First is expected losses. So expected losses are those losses which a business expects from the business portfolio, from the portfolio that it has. So based on the lending strategies, based on its account management strategies, the business is able to create a forecast of these losses. Now, these losses are generally not of very high magnitude, right? A typical so in a typical banking portfolio, an expected loss would cover say around 0.02%, 0.03%, or say 0.12% of losses. So these are the loss percentages that we generally get to see for expected losses. So generally, if you have a expected loss of around 2.5 to 3%, banks would be very concerned about it because that would mean that there is some deficiency with the management, the risk management system that the bank has in place, right? So generally, these loss percentages are not very high. So the second type of loss is the unexpected loss. The unexpected loss is nothing but the deviations of losses framed about the expected losses. And after that, the next part is the potential loss. The potential loss is a loss which does not which generally does not occur. It has a very rare frequency of occurrence and such a low frequency that you can say that it occurs once in 1,000 years or once in 500 years, like this. So, however, if that loss actually occurs, the entire banking system may actually collapse, right? So, the bank needs to prevent itself against the potential losses as well. So, over here, what we get to see is that the bank needs to keep aside funds to absorb these three kinds of losses. First set of losses that the bank needs to prevent itself from is the expected loss. The second source of loss is the unexpected loss, and the third is your potential loss, right? And the bank has adequate amount of capitals divided into layers to prevent itself from each of these kind of losses. And therefore, after the 2008 financial crisis, there has been an increased focus in making banks capital adequate so that they do not involve into toxic lending activities as they had done in the year 2008. So therefore, the objective of this particular exercise is to explore the different regulatory requirements which are present there, and would help the banks cover up for these losses. So that is the part where we need to kind of start working with. Or that's the kind of thing that we generally work with. So over here, when we are talking about this regulations, or so when we are talking about guidances to make the banks capital adequate, or when we are talking about the capital adequacy of banks, what we are essentially referring to is certain regulatory frameworks. Regulatory frameworks which ensure whether the bank is adequately capitalized or not. And one of the famous regulations that we hear a lot about, regulation about which we get to see a lot of emails in our LinkedIn profiles, or a lot of emails into our inboxes, is BASEL. Experience required in Basel model development, PDLGDEAD model development, linear regression, logistic regression, time series. So these are so basically from the kind of the mails or the shooters that come into our inbox, we can actually make out that this particular regulation is somewhat which is very important. It is not only important from the perspective that it is not only important from the perspective that it lays down capital requirement, like it lays down it is you develop PD, LGD, EAD models, but there are a lot more to this regulation, right? So as we had discussed in the last session, the Basel sections are divided into three parts. One is so it has three pillars. So first, the one of the pillars is the minimum capital requirement, right, where it states that where it requires the bank to keep aside sufficient amount of capital against each of these three broad sources of risk: the credit risk, the risk which arises from lending, the market risk which arises from market fluctuations, and operational risk which arises from issues of failures in operational chains. Then what we have is the borrower's risk. So basically, after talking the minimum capital requirement, the regulation also talks about supervisory reporting, and then to market discipline, right? Now, the entire objective of Basel as a regulatory, as a regulatory document or as a regulatory framework, is to ensure that the banks are prevented from each of these three layers of shocks. Are like so that the bank is prevented from each of these three layers of shocks, which comprise of expected loss, unexpected loss, and potential loss. So the bank needs to be adequately capitalized so that it can absorb any of these shocks, right? So it is so expected loss or creating sufficient amount of provisions for some sufficient amount of provisions, sufficient amount of uh, like keeping a sufficient amount of provisions against the expected loss is just a part of it. It aims to ensure that the bank is capitalized such that it's adequately capitalized such that it can absorb losses arising from expected loss, unexpected loss, or potential loss, right? And the bank needs to keep aside sufficient amount of capital for that. So as we saw that in the last discussion, that in the capital tier, right, there are three capital tiers of capital that we generally talk about. Out of that, tier one capital is the core capital because it is the capital which is funded by the equity. This is the part capital which the bank raises by issuing equity papers, right? So it's the most core and the more purest form of capital, and it is this part which should be adequate in size, which is which should be adequate in size, which can absorb all unexpected losses and uh, potential losses. On the other hand, the expected losses are covered by the tier 2 capital, which is the supplementary capital, right? So this the tier 2 capital will comprise of all kinds of predicted or estimated kind of capital requirements like provisions of doubtful debts. So I'm actually keeping aside. I'm expecting that so and so debts might be doubtful and they might be defaulting over time, and hence against them I'm keeping aside certain amount of money. So this is a part of expected loss. The expected loss and provisioning for loans and these losses, they go under capital tier 2. But since tier 2 capital is a predicted capital, it is also subjected to the judgment of the management. Therefore, the regulators have imposed a condition that the tier 1 capital has to be greater than equal to the tier 2 capital, right? So after this, the next part that we started talking about was the three components. So basically over here we started building that framework, right? That how does expected loss, unexpected loss, capital and ED, EAD frame about, and ultimately how is it that they get interlinked with each other. And we saw that that the first stage whenever we start off with capital calculation, right? So our objective is finding to calculate the amount of capital, the amount of capital which would preserve the bank against kind of unexpected losses, potential losses, etc. So over here, so over here we saw that the first stage of computing the capital requirement is to compute the expected losses, right? So once we compute the expected loss, we would get, so the deviations from the expected loss would be an unexpected loss. From the unexpected loss, we compute the RW, and from the RWA, we compute the capital requirement. So these are the different steps. So the most important step right at the outset is computing the expected loss. And to compute the expected loss, we require these three inputs. What are the three inputs that we require? One is a PD model, the second is the EAD model, and the third is the LGD model. And the product of all these three is the expected loss. So we have also discussed as to why expected loss is the product of these three variables. So for now, so we'll not enter into the background logic at this point of time. For us, the idea is that it's the product of these three models, and therefore these three models or these three set of models need to be constructed, right? Now, when I talk about this accord, right, constructing a P model or LGD model might seem to be a very fancy task, right? And people are, everyone is looking out to make an opportunity to risk modeling. But this is quite it's quite a difficult, and it's a very rigorous activity as such. The reason being that you have your basically, if I am to develop these three models, there are two things that you need to keep in mind while developing these models. The first set of things that I need to keep in mind is that what exactly is this PD model? So basically, what is the PD model? The PD model helps us estimate the chances that a borrower will default in the next 12 months. So that is what the PD model is. And when I'm developing the PD model, I need to ensure that the PD model is compliant with the BASEL regulations. And when I talking about regulations, regulations differ from portfolio to portfolio, sub portfolio to sub portfolio. And therefore, the first question that we need to address over here is that we need to find portfolio for which the model development exercise is actually being done, right? So over here, the next part that we need to talk about is that, so that is the reason why we started talking about the portfolios first, right? So we started talking about uh, what are the portfolios like, right? So whether it's a retail portfolio, the commercial portfolio, within the retail portfolio, what are the divisions, and so on, right? And that is the part where we left off. So basically, when we are developing these models, right? So there is, when I'm talking about a model, so I'm talking about a dependent variable and an independent variable. Now, obviously, the independent variables would differ basis the products. So the independent variables which explain the probability of default for a credit card would be very different from that of a mortgage, and that in turn would be very different from the you know from that of a commercial product. So therefore, before we move into that, we need to understand how the Basel framework defines these different portfolios and how is the portfolios structured. So once we know about how the portfolio is structured, from there we can actually take up the material. From there we can actually take it up, and we can start developing all the models and all models and stuff, right? So that is what we can do. So that is the part with which we had started, with which we had closed our discussion in the last class. So basically we see that Basel classifies the banking portfolios into two broad groups. One is the retail group, the other is the commercial group. Now, the retail portfolio is a portfolio where you have large number of accounts and you have extremely small exposures, right? And these accounts are collectively managed. And when I say it's a small exposure, so what do I mean by a small exposure? By small exposures, I mean exposures which are less than 1 million, or so exposures less than 1 million euro, right? 1 million euro or less, and these are collectively managed. On the other hand, the commercial portfolio is a portfolio where your obligors are firms, and given that they are firms, obviously the number of obligors in a commercial portfolio is likely to be relatively lower compared to the retail portfolio, right? So basically, say in a credit card portfolio where you might have 3 million, 4 million accounts in a small medium enterprise portfolio, SME and corporate portfolio, the number of obligors who has taken the loan would be much less, because number of farms are much less compared to the number of individuals. Therefore, the number of obligors in a commercial portfolio should be ideally lesser on an average relative to that of the retail portfolios. Hence, but however, once that is done, even though the number of obligors is small, I mean less you know relative to the retail portfolio, but the exposure per account exposure is actually very high, right? Because when I take a loan from a bank, I'll take it around 5 lakhs, 10 lakhs, 20 lakhs. But when a bank or when a commercial product takes, or when a commercial person takes a loan, they take loan in crores, right? Crores or hundreds of crores. Therefore, therefore, what we get to see is that the easiest way to identify a retail and a commercial portfolio is to ensure that, okay, so in retail there would be large number of observations, and each of the observation will be having very small exposures. For the commercial portfolios, what we'll have is small number of obligors, and the exposure of the accounts will be relatively large, right? Akash, does that answer your question? Great. Now we'll take up one portfolio. We'll take up each portfolio, kind of independently. So one case over here is that in the retail portfolios, there are three sub portfolios. One is QRRE, which is nothing but the qualifying revolving retail exposure. The second is the mortgage, and the third is the other retail. So these are the three things that we will be talking about. And then we go to the commercial portfolio. First of all, what is QRR? QRRE talks about QRRE talks about qualifying revolving retail exposure. Q stands for qualifying revolving retail exposure. Qualifying revolving retail exposure. Now, the products that are involved that are there into this is, so we can talk about two broad type of products. One is credit card. The other is a overdraft. Right. So over here, what we have is the qualifying revolving retail exposure. So within qualifying revolving retail exposure, we have credit cards and overdrafts because these two are kind of revolving products. Now, when I talk about a revolving product, what do I mean by a revolving product? Now, one of the most distinctive characteristic of a revolving product is that it's a open-ended product. So basically, a revolving product is an open-ended product. Open-end, right? Now, when I talk about an open-end product, now when I talk about an open-end product, then what do I mean? What it means essentially is that this part or this product does not have a fixed term over which it needs to be repaid. So, for example, when you own a credit card, right, what you are doing is you are just paying back the credit in time and you are again reusing that balance. But what you are not doing essentially over here is the following: you are not kind of, so what you are doing over here is you are just paying back your dues, you're releasing that limit, and you are just working on with that. So, therefore, there is no fixed maturity. Over here, the idea is there is no fixed maturity. There is no fixed maturity. Right. Now, given that there is no fixed maturity, right, the person keeps on revolving on that balance. So a revolving product is characterized by two very important characteristics, or it's characterized by two very important features. One is the balance. So the balance is ideally which is kind of used used part of the limit, or the drawn balance part of limit. So every credit card comes with a limit variable, right? So every balance is a part of a limit. The next part is the limit of the card. So what is the limit of the card? That is the maximum permissible usage. So if my limit of the card is 50,000, then what I can do is the maximum I can do. So what I can do is I can actually pay. I can actually use my card up to 50,000. So this is where kind of this limit is usable. This is the maximum usable limit, or the maximum usage that I can do on a card. Now, the balance is the one which is the used part. So basically, say suppose if I have a limit of 50,000 and I have a balance of 20,000, right? So if I have a limit of 50,000 and if I have a balance of 20,000, then what it means is that I'll have a utilization on the card. So I've utilized 40% of the limit of the card. So my utilization is 20k by 50k into 100. So basically what I have done over here is I have used 40% of the total limit. So therefore, the balance that you get to see, it's a billing feature. It's a feature of the credit card bill, and balance outstanding simply means that this is the amount which the person has used, right? And so this is the amount which is outstanding on the card as on this month. So this is what is this limit all about, right? So this is how, or this is what we have used, so this is what is utilization. Now, obviously, if I'm using a certain portion of my limit, right? So there, and then that's the drawn balance. Then I'll obviously have an undrawn balance corresponding to it. So the undrawn balance is nothing but it's also known as the headroom. The headroom. The headroom is nothing but the limit minus the balance. So this is where the headroom is. So over here what we have is limit is equal to 50k. The balance used is 20,000. Utilization is 40%. Therefore the headroom is limit minus balance, right? So the headroom is generally your undrawn balance. So obviously, when we are trying to estimate the riskiness of a borrower, right? Estimating the riskiness associated with a borrower for a revolving product is much more challenging because there are two sources of this credit. One is a drawn source and the other is an undrawn source, right? So, and before he goes into default, he may just withdraw that amount and then he may go off to default. So over here, we need to when we are assessing the overall riskiness of the borrower, we need to ensure that, right, that both the drawn and the undrawn balances are actually being used. Clear? Any questions up to this point? Great. Akash, are you clear on this? Great. Okay. So next is there are a few other important features associated with revolving products as well, right? So like we saw, one of the important variable was utilization, right? So to assess the riskiness associated with a credit card, right? So with a revolving product, there are a few important things that we also need to look into. So we just cannot go and kind of just say that okay, this guy is a risky borrower because his utilization is more. Now, utilization shows the demand for credit of a borrower. Now, on the other hand, whether a borrower is a good borrower or a bad borrower, or whether he is a risky borrower or less risky borrower, one very important metric to assess that is also the payment balance ratio. So we also need to assess the payment patterns of the borrower. We also need to assess the payment patterns. So before we decide on any kind of riskiness, or before we decide upon okay whether the model should, or whether uh, the borrower is a more risky or a less risky borrower, so we just cannot look into utilization and make our conclusion. We also need to look into we also need to look into the payment patterns that the borrower has. So therefore the payment patterns is an important part, or assessing the payment patterns is important. And what is this payment patterns that we are talking about? When we talk about the payment patterns is one of the very key variables which capture the payment patterns of a borrower is the payment balance ratio. The payment balance ratio. Now the payment balance ratio will give me an idea that how much of the balance is this guy actually paying back. So what exactly is the payment balance ratio of the borrower? Right, so over here this is something that we need to assess. If you have a look into this, so say for example, how do I identify a very risky borrower from a low risk borrower? So one very simple way to do this identification is to use look into the utilization, right? So look into the utilization and look into the payment balance patterns. So if the guy's utilization is high as well as his payment balance ratio is also high, then I know that okay, this guy is using the credit but he's paying back it in time. On the other hand, if a guy has a very high utilization followed by a very low payment balance ratio, then I know that this guy has a very high utilization of the credit, but he's giving back hardly, right? So, by looking into the payment balance patterns and by looking into the utilization patterns, right, we can actually make out whether the revolving portfolio, revolving retail exposure, or whether the borrower in the revolving retail exposure is more risky or less risky. Now, over here, before I proceed further, so Akash is a question: what percentage of utilization of credit limit is considered as safe utilization? So generally, like credit bureau experts, they say that people should not be, having. I mean, it's always safe to have an utilization less than equal to 30, right? So you utilize 30% of your credit card limit and you keep on giving it back. But generally, what we can see is that if your utilization is less than equal to 50%, then that's okay. However, if you have utilized your card to a very high limit like 95%, 99%, that is where a certain volatility starts coming in, right? So that is where this particular problem starts coming in. So therefore, what we need to do over here is the following. Uh, so therefore, we can just, let's do a very simple exercise to assess the overall riskiness of a borrower. So let's say that the utilization of this guy remains anywhere around 30%, right? So this is say 30 and this is say 10. So it remains between 10 to 30%. Say this is what my uh, utilization is, right? So my utilization always remains within the band of 10 to 30. So this is what is utilization. Utilization, right? Now, however, what I see is that the payment balance ratio that this guy has lies between 0 to 10%. So now what I can see from here is that if the guy uses a relatively higher proportion of the balance but hardly pays back anything. Therefore, what I can make out is that this guy is a relatively risky guy because this guy would be using the credit but would not be paying back it in time. right? So therefore, by using these variables, by looking into these variables, you can actually make out the overall riskiness of a given borrower for credit cards, right? So that's one. Now another important variable which gives us insights into the into the behavioral risk associated with credit cards is, or associated with open-ended products, is the delinquency variable and the month on books of the variable. So there are two variables. The next two important characteristics associated with credit cards that we'll talk about are: number one is your delinquency variable. Your delinquency variable. So the first is delinquency variable, and the second is your month on books in, right. So the second variable that we talk about over here is the month on books. Now these two variables again are very important variables for explaining the overall behavior of, the overall riskiness of a borrower's behavior. Because when we are in the when we are developing the Basel models, we are not developing any acquisitions type of model. We are already exploring into the, we are exploring into the behavioral set of the models, right? So this is the reason as to why all these variables, if you observe the nature of these variables are sourced from the behavioral factors, the behavioral patterns of the borrower. So another important thing to observe over here is that individually the variables may not be giving a very clear picture about the riskiness, but when variables are derived from them, right, or covariates are created from them, these variables given a very good insight into the overall behavior of the borrowers, right? So, if I have a look into this code, or if you have a look into this particular thing, you'll see that for the limit, so over here, limit and balance may not be giving us a very good idea about the usage or how our account is using his, or borrower is using his account. But when I coin the measure utilization, I get a more clear picture about how different accounts are behaving over time, right? Now, similarly, when I look into the payment patterns, right? Just looking into the payments, does the absolute value of the payments does not give me a very clear idea about what exactly is going on. So, who is a better borrower and who is a relatively worse off borrower? But when we look into this, But when we look into this payment balance ratio, you will see that we can get a better idea about the willingness of the borrower to pay back. And when I compare the utilization and the patterns of the payments of accounts over a given period of time, we get to see that we can actually identify the willingness of the borrower to pay back by looking into the utilization pattern and by looking into the payment balance pattern, right? So if I see that the payment balance ratio is has been historically very less compared to the utilization ratio, then I can say that yes, this guy has been, or so so this guy is actually paying back much less than what he is actually utilizing, and therefore his willingness to pay back is less compared to a guy who is paying back a larger portion of the total outstanding balances. So when I use these derived variables, these covariates, we get to capture the willingness of the borrowers to pay back very nicely. right? Therefore, the role of in developing these models, right? The role of covariates is actually very important. Only primary variables cannot help you much. You have to create covariates, and creating the appropriate covariates is actually a major step in this exercise. Clear? Okay. So before I move on, I'll take up a question that Preeti has over here. Yes. So, uh, yes. So as you have correctly identified, Preeti, Akash, MOB stands for the month on books. The number of months an account has been on the books of the bank. So if I open a credit card account, if I had opened a credit card account since 1st Jan 2015, then today I would be some 36 and by 41 months on books of the bank, right? So I would be on the books of the bank for 41 months. So this is what the overall idea is. Right now, we'll talk about month on books and delinquency, and we'll see how these are important variables in the model going forward in developing Basel models and so on. So over here, talking about the first important thing, talking about delinquency. So what is delinquency? So delinquency is the act of missing out on a given installment payment. So delinquency of an account actually arises when the account has missed out on the payment of a variable, the payment of an installment. Missed payments on EMIs. Missed payment of EMIs. Right. So missed payments of EMIs. Now the question that comes out over here is that why is delinquency such an important variable over here? Right. Now observe that delinquency will give us an idea about your overall risk. So it will give us an idea about how risky a particular borrower is, right? So is a borrower risky at all or not? So basically, it has been generally seen that borrowers who have a tendency of going delinquent more frequent, right, have greater chances to default, right? So therefore, by looking into the delinquency patterns of the accounts over a given period of time, we can actually try to identify whether how risky, whether a particular borrower is risky or not. So basically, the delinquency patterns over time gives an insight on the borrower's riskiness. Within this pattern over time, the pattern of delinquency over time gives us an idea about the willingness to pay. It gives an idea about the borrower's willingness. about the willingness to pay. Right. So therefore, we generally look into the different kind of you know we are looking into different kind of like risk tendencies. So if you look into the different variations of delinquency variables, you should be able to identify whether the borrower is or like how risky or how less risky a particular borrower is. Now, some of the important variable, one important variation of the delinquent variable will be the percentage of delinquency in the last 12 months. So, out of the last in the last 12 months, what percentage of time has the account been delinquent? So, say in the last 12 months, the account has been delinquent four times, the account has been delinquent once, the account has been zero. So, based on that, this percentage of delinquency variable can be created. The percentage of months delinquency for the last 12 months. Over the last 12 months. Right. So over here, what we are trying to identify is that what is exactly the percentage of delinquency over the last 12 months. Right. The number of times, the greater number of times an account has been delinquent in the last 12 months, the more risky the borrower is. Right. So, so say for example, the greater the percentage of time account has been delinquent in the last 12 months, the greater is the chances of the borrower to also default in the next 12 months, right? So basically, if let's say there is a borrower who has been delinquent say four times or five times in the last 12 months, right? Then what happens is, so what it means is that there is always a higher chance that this borrower would go into default, would become delinquent and never recover, right? So there is always a chance. Therefore, by looking into this percentage of delinquency over the last 12 months, what you can actually do is you can identify whether a borrower is a risky borrower or not, right? So therefore, this delinquency variable becomes very important. In fact, when we are developing BASEL models, right? So there are multiple levels of segmentation that can also be done. And then one of the major segmentation criteria is based on the delinquency. So so the entire model development sample can be divided into three parts. One is active. So when I talk about active accounts, I mean active non-delinquent accounts. The second segment is the delinquent segment. So this is the risky segment. And the third segment is generally the inactive segment. So it is generally seen that accounts which are delinquent as on a given snapshot these accounts tend to default relatively more over the next 12 months compared to the active account which are non-delinquent. So basically, this is a segmentation exercise which is generally, which generally happens when we are developing our own models, where the entire population is divided basis their riskiness: active borrower, delinquent borrower, and inactive borrowers. Right. So basically, if I'm so basically when probability of default is being estimated, the inactive segment or the inactive segment is something which needs to be very careful about, because these are accounts which have not been performing over the last 12 months, so they have not been playing a role, but that does not guarantee that they will not play a role in the future, right? So this is this is where this particular exercise happens. So basically, what I have is active, what I have is active, delinquent, and inactive. So for the inactive segments, right, we generally do not develop any models. Excuse me, guys. Okay. So as I was saying that, so basically for these three segments, the active, delinquent, and the inactive segments, right? For the inactive segments, no, generally no separate models are developed, right? So basis the historical experience, a PD is assigned to it and with a buffer, right? Because you do not have any ways to identify what whatsoever their behavior could be. Right, so the two basic segments on which models are generally developed, for PD models are developed, is one is the active segment, which is your non-delinquent segment, and the other is your delinquent segment. And it is generally seen that a delinquent segment in a credit card for a QRRE is relatively more risky than a non-delinquent segment, right? So these are so this is how the delinquency variable becomes important. Now, what I've said is I have just defined a very specific variation of this delinquency variable, right? There would be other variables as well. So so there can be other variants of this delinquency variable which can be created, right? Say for example, one of the very important one way I can do is I can check that how many months at a consist at consecutively has this been, how many months consecutively has a guy been into delinquency, or for how many consecutive cycles has a guy been into delinquency over a point of time. So these are some of the variables that we can actually design over here. Right, so delinquency variable is actually a very important variable for model development, for developing these behavioral models. Right. Now, the second set of variables that is relevant for that is relevant for this behavioral group of models is the month on books. Now, one very important role that month on books generally has to play over here is, So, one very important role that month on books has to play over here is that it talks about the seasoning of accounts. Month on books help identify seasoned accounts versus unseasoned accounts. Basically, when you are developing your models, right? Basically, when you are developing a probability of default model, especially for a retail portfolio, you need to understand that which of the borrowers are seasoned borrowers versus which of the borrowers are unseasoned borrowers, right? So for the borrowers who are seasoned borrowers, for borrowers who are like seasoned borrowers, developing a model on them is relatively more robust and more reliable than developing it on unseasoned borrowers. Because if a borrower is not is an unseasoned borrower, then you do not have a very clear picture about what this guy is going to be like. Say this guy has been only 3 or 4 months on the books of the bank, right? And he has been paying his EMIs in time. And based on that, I consider him to be a good borrower, and I place him under the active segment, and I get a get a relatively lower PD estimate, and everything is done. But when as the borrower matures, say over 8 months, 9 months, 10 months, he starts getting he starts getting delinquent, right? So the PD that I would have estimated for this guy would be an underestimation. Therefore, what I need to actually do is I need to ensure that the model that I have, although what I need to ensure is that the amount of risk that I should associate with this guy should be sufficient. Therefore, the non-seasoned accounts are accounts for whom the PD is assigned and a buffer is laid on it, right? So that even if they go bad or even if they start going bad, then there will always be a buffer to take that up, right? So I put in uh, a layover PD on that to make it a more conservative estimate. However, if those segments they season successfully, then the PD estimate that I would have would be a conservative estimate. Therefore, seasoned accounts are treated separately while developing a Basel PD model, and the unseasoned accounts are treated separately while doing while developing a Basel PD model, Basel PD QRRE model, right? So basically, the next thing that we talk about over here from the point of view of QRRE is the role that month on books has to play on this. Now, what month on books does is, so what we see generally is that as the accounts season. So what is a seasoned account? So a seasoned account is an account which has been there which has been on the books of the bank for sufficiently long time, and given that it has been given that these accounts have been seasoned, right? They have been on the books of the bank. Uh, so given that these accounts have been on the books of the bank for sufficiently long time, the chances of these borrowers to default becomes lower, right? Hence, what happens is we say that these accounts are seasoned. Therefore, we see that once the account becomes seasoned, the portfolio bad rate falls. So if my portfolio is comprised of a significantly large proportion of seasoned accounts, then the chances of losses in my portfolio generally tends to fall. I mean, chances of losses in my portfolio generally reduce. Right? So, so generally for the seasoning analysis, what we require are the two things. And over here, what we have is the bad rates. Have is bad rates. So basically, what happens is we see that for the lower month on books, for the lower vintages, the bad rates tend to increase. And after a point of time, it stabilizes and then the bad rates tend to fall. So the point where this point, the inflection is reached, and the bad rate starts falling. This is known as this is known as the you know this is known as the month on books. And this is known as the seasoning period. So where the the bad rates peak and then start falling. So basically, what it means is that once the vintage of the borrower hits M star, right, the bad rates stabilize, and for accounts which have month on books greater than equal to M star, those accounts become seasoned accounts, and once the accounts get seasoned, they start, uh, the overall bad rates start falling, right? So this is known as the seasoning analysis. So therefore, no breathing. This is not vintage analysis. In vintage analysis, we take the cumulative loss rates. Over here, I am taking the bad rates. So in vintage analysis, you look into the cumulative loss rates where the loss rates stabilize. And over here, we are just looking into the individual bad rates over the month on books, right? And it is seen that as the overall age of the portfolio matures, the loss rates gradually stabilize. Whereas if you have a lot of accounts which have M star, have month on books greater than M star, you know that your portfolio is more or less seasoned, and the chances of the borrowers to default after this point is actually very less, right? Okay. So is the idea of the seasoning analysis clear? Now, seasoning analysis is one of the very critical analysis for developing a Basel retail model, right? So after this, so from here, one important thing that we need to understand is what are the key variables which impact or which would help us identify the riskiness of a borrower or would help us assess the behavior risk of a borrower for credit cards. Key variables for QRIs. One very important variable that I have over here is balance. The other that I have is limit. The third that I have is payments. The other that I have over here is delinquency. And the final that I have over here is, so after delinquency, the next that I have over here is month on month. So these are the few core variables that must be there for developing a PD model, or for example going forward in EAD model for credit cards, right? So I'll just take this question up from other first and then carry on. So basically, so Akash is asking, season analysis done on every account to check whether an account is seasoned or unseasoned. No, Akash. So this is done on a month on books basis. Right, on a month on books basis. So the entire data is categorized in terms of the month on books, and for each month on books, the bad rates are calculated, and then what we do is we check whether then we plot the bad rates corresponding to the month on books, and then we see that what is that age or what is that vintage corresponding to which the bad rates are stabilizing and then falling down, right? So it is not done for, so they once we know what the month on book is, and then every account can be flagged as a seasoned or an unseasoned account, right? Great. So these are the key variables. So when you have a data, right, and you are developing the model for, yes, so bad rate over the time for which the data is there, right? So if you have data over last 5 years on a monthly basis, then what you do is for each of the years you will have month on books which has equal to 4, equal to 5. So you just group them by the month on books. The time is not important. The time factor over here is not important. It's about the month on books. So on an average, over the entire time period, what has been the overall bad rate for accounts which have month on books equal to 4, right? So this is what the overall requirement. So when we are doing any data quality check or any other such exercises, what we need to ensure is that the model is, so what we need to ensure is that these variables are absolutely crucial and that they are in a proper order. So there must not be any challenges associated with these variables if we are to develop a EAD model, PD or an EAD model with PD or EAD model for QRRE products, right? Okay. So, guys, I'm not really feeling well today, so I would like to take a break now. We'll continue with this portion in the next class. Thank you. Thank you, everyone. Thank you.